you saw gold ETF holders liquidate 1.6 million ounces of gold between the middle of May and late last week. That really was the major factor. So then you can say, well, why were they selling?
Do you think the bottom is in, or can gold fall further from where we saw last week?
The potential for it to spike down and actually touch 4,000 or even go down to 3,800, which is where a lot of technical people are looking, somewhere between 4,800 and 5,000, I think is the range for the next couple months. In 60 days, the Iranians are not going to agree to give up the uranium. I'm surprised and shocked that people have actually bought and sold stocks, bonds, currencies, and precious metals based on him saying, oh, we're 2 days away from a treaty. The economy is showing up a little bit stronger than people thought. Employment data is showing up stronger. Unfortunately, inflation is also pointing toward higher prices, higher interest rates, with another wave of investor anxiety pushing prices higher.
Gold was having a price decline last week, and I know that investors had a lot of questions about what was causing that. So from your perspective, what was behind that fall in the gold price last week that we saw?
A lot of information is secret in the precious metals market, spot purchases and sales, but you get the ETF data. And if you look at the ETF data, you saw gold ETF holders liquidate 1.6 million ounces of gold between the middle of May and late last week. And that's really was the major factor. So then you can say, well, why were they selling? And, I hate to say it, but one of the reasons they were selling is that the price has been falling since it reached its peak in February. And a lot of these ETF investors are not traditional buy and hold physical gold and silver buyers. They are more opportunistic. They saw the gold price rising after August through January, and they bought ETFs. They bought an enormous amount of ETFs in that 5-month period. And then since February, they've been just selling, and they accelerated their sales pace over the last 2 weeks, partly because the price was falling, partly because the stock market was rising, and partly because the economy looked better than they had expected it to.
Okay, I think that gives us a good idea of what was going on last week. And as we were having that fall in the gold price, it was generating, I think, a lot of discussions on whether we have seen the bottom for gold. So I'm curious to get your thoughts on that. Do you think the bottom is in, or can gold fall further from where we saw last week?
Gold fell, but the bigger story is who left and who quietly stayed. Jeffrey Christian notes that 1.6 million ounces exited gold ETFs in weeks. Yet that doesn't automatically signal institutional abandonment. The fast money ETF flows often chase momentum, while long duration wealth protection behaves differently and rarely shows up in headline narratives. Retail investors who mistake ETF selling for a collapse in conviction risk handing over positions at precisely the wrong time. Next, Jeffrey Christian exposes why temporary liquidation and real demand are sending opposite signals.
The price can fall further from where it is. I mean, we've been saying that we thought that the price would consolidate it in a very volatile range between April and August, through August. And the range so far has been like $4,065 last week and say $4,900. The potential for it to spike down and actually touch 4,000 or even go down to 3,800, which is where a lot of technical people are looking, I think that's a reasonable bottom. But, our view is that the price moves sideways in a very volatile fashion for the next 2.5 months. Whether it gets below 4,000, I don't know if that's going to happen. These are very volatile markets and very volatile and economically uncertain times, and investors are flopping around back and forth.
Yeah, I remember when we spoke in March, we talked about that trading sideways, but the price will be volatile. So it sounds like that's what we're going to be seeing, at least for the summer. What would you say is the upper limit on that range? We've talked about the lower, but what would be the upper?
Somewhere between 4,800 and 5,000, I think, is the range for the next couple months. We do think that it goes higher after August, into the final 4 months of this year.
Okay, and we'll get into that a little bit later. I wanted to speak about gold price activity that we're seeing today, because after last week's decline, this week we're seeing a rebound. We're talking on June 15th, so it's Monday, and we've had this news of a potential peace deal between Iran and the US.
The most expensive investor mistake is confusing consolidation with safety. According to Jeffrey Christian, a volatile range with downside tests and upside rebounds may persist for months, but timing matters more than direction. Historically, sideways periods are where weak hands exit and patient capital accumulates before repricing phases begin. Investors focused only on headlines miss that volatility itself can become the transfer mechanism from reactive money to strategic holders. Next, Jeffrey Christian reveals the contradiction hidden inside short-term rebounds and long-term positioning.
We'll see how that plays out, but to what extent do you think that price rise that we're seeing is related to that? Is it highly correlated to that, or are there other factors at play?
I've been shocked over the last several weeks because President Trump has continually said, "Oh, we're going to have we're going to have peace." I mean, he started, he attacked on February 28th, and on March 1st, he said, well, this will be over in a day or two. And March, April, May, half of June, for 3.5 months, he keeps saying, oh, we're on the threshold of a deal, we're talking now. And the Iranians say, we're not talking, and we're nowhere near a deal. And even if you look at the current deal, but I've been shocked at the extent to which precious metals and market participants and others in equity and bond markets have paid any attention to what this guy says. I mean, he's a serial liar, and he's a serial dishonest about this. And yet, he was saying last week, oh yeah, we're a couple days away from having a peace agreement. And I think I know people who were selling based on that idea. And we were saying, you've got to be kidding. You're selling based on what this guy is saying about this. Now, if you look at the present, what they've got is a memorandum of understanding, which says, hey, we're going to have 60 days of further ceasefire, during which time we'll resolve everything else. Now, I was listening to the details yesterday, and I turned to my wife. I said, are these guys that naive?
Markets reacted to headlines again, but price action and diplomatic reality stopped agreeing weeks ago. What Jeffrey Christian is highlighting is not geopolitics itself, but the willingness of capital to front-run promises before outcomes exist. When markets trade assumptions instead of signed agreements, volatility becomes a transfer of wealth from emotional participants to disciplined allocators. Investors protecting purchasing power should pay attention to actions, not optimistic timelines. Next, Jeffrey Christian exposes why political optimism may be suppressing the very fear trade investors expect.
Because in 60 days, the Iranians are not going to agree to give up their uranium. They're not going to agree to give up their defense, including nuclear power, weaponry potential. And the United States is not going to give up on its side. So in 60 days, Trump is going to have to resort to his bluster again, because this is not going to be resolved in 60 days. But what will happen is in 60 days, you're going to be in the middle of August, which means that you're going to be, 8-10 weeks away from the midterm elections. So he's going to have a tougher domestic political environment in 60 days than he has now. And he's set himself up for that. So I'm surprised and shocked that people have actually bought and sold stocks, bonds, currencies, and precious metals based on him saying, oh, we're 2 days away from a treaty. And I think that the memorandum of understanding that is being worked on this week, although he said it's been signed, he's in Paris now for the G7, or in Evian for the G7. And he said today that it's been signed. It hasn't been signed. It hasn't even been written yet. And, he's just setting himself up for further chaos and uncertainty.
Yeah, I almost hesitate to bring it up because there is so much uncertainty, but I think it's worth talking about. And it's interesting to see your surprise at how people have reacted to the Iran war in terms of gold. I think among our audience, I've seen a lot of questions about why isn't the gold price higher when we're in this situation of conflict and geopolitical turmoil.
The market keeps pricing peace faster than history ever delivers it. Jeffrey Christian's argument suggests investors are underestimating how political calendars distort economic expectations and commodity flows. Temporary calm often delays repricing rather than preventing it, especially when unresolved conflicts remain financially expensive. For wealth preservation, the danger is not missing upside, but assuming uncertainty disappeared because headlines became quieter. Next, Jeffrey Christian reveals why gold sometimes pauses before uncertainty actually peaks.
So do you think that also ties into what you've been noticing about how people are reacting?
Well, yeah, and we're in a tough period now, and one of the things that we pay a lot of attention to is the way gold and silver investors buy and drive the price higher in times of severe economic and political problems. And you saw this in the Depression, you saw it in World War II, and I think you're seeing it now where, there's an initial rush to buy gold and silver and the prices go up high. And then there's a pause when it's not that the chaos and risks and uncertainties and anxieties are normalized, but they are to some extent. I guess that, I don't want to use that term because it's not like a long-term normalization, but there's a pause or a plateau where people say, okay, I've got my gold and silver. Now let's see what happens. And that's sort of where we are right now. And as far as we can tell, we're in a position where people have been buying a lot of gold and silver, in concerns about all of the risks, not just Iran, but all of the risks and uncertainties that the world's facing. The economy is showing up a little bit stronger than people thought. Employment data is showing up stronger. Unfortunately, inflation is also pointing toward higher prices, which is suggesting higher interest rates, which is sort of a headwind to some extent for gold and silver. So, you're sort of in this pause period right now. And again, we think that pause period could last for a couple months now before we see another wave of investor anxiety pushing prices higher.
Rising gold with cooling momentum is usually where conviction gets tested. This is where Jeffrey Christian's thesis shifts from crisis buying to investor endurance under uncertainty. History shows that after initial fear purchases, markets enter uncomfortable plateaus where narratives stabilize before fundamentals move again. Savers who interpret pauses as tops often end up re-entering at materially higher prices later. Next, Jeffrey Christian unravels why stronger economic data may not be the relief signal markets assume.
More and more people in the United States are mad at the Trump administration for this war and for the economic consequences within the United States of this war. And the Trump administration said, let's put this all on hold for 60 days until we're 60 days closer to the midterm elections, right? So the Iranian negotiators are fully aware of the U.S. political system, and they know that in the middle of August, when those 60 days are up, the Trump people are going to be even more desperate to try to put lipstick on this pig. Yeah. And it's going to be more damaging to Republican efforts to maintain the House and Senate. So it's almost like the Trump administration is incredibly naive to reach this to agree to a memorandum of understanding saying, let's wait until it's even more dangerous for us to have this hostility. What are you going to do in November? In the middle of August, are you going to say, okay, now we're going to start bombing again? We're going to increase the war effort? Meanwhile, you still have Ukraine. Trump's in France this week for the G7. The G7 is like really upset with the U.S. administration, as is everybody else. It's just there's all kinds of economic and political issues that could come together in the last 4 months of this year to cause investors to say, the price of gold went from $2,600 to $5,000 between August and January, August 2025, January 2026. What's it going to do this year? And I think that our expectation is weaker economic conditions, continued political problems, continued war between the United States and Iran, possibly other political conflicts arising, ongoing problems with the Ukraine.
Political delays often create bigger market reactions than political decisions. Jeffrey Christian notes that pushing difficult outcomes further into the calendar can temporarily calm markets while increasing underlying uncertainty. Institutional capital rarely waits for headlines to confirm risk. It positions during periods of public optimism and policy delay. Investors focused only on election narratives may miss how macro stress quietly accumulates underneath asset prices. Next, Jeffrey Christian reveals why delayed conflict resolution can accelerate demand for hard assets.
Issues related to the Trump administration's relationship to Putin. We haven't even talked about North Korea, China, and Taiwan. There are all kinds of issues that probably will come together and create an ill-easy feeling that's going to cause investors to say, okay, and where's the stock market? Is the stock market going to be at a record price? Are more and more investors going to say, oh my God, the stock market is at a record price because there are all these shell companies, AI and spacecraft. Let's be honest, that thing's never going to be profitable. No investor will invest in SpaceX waiting for the dividends. It's a joke. The stock market has done very well because a few companies of spurious economic value have had very sharp increases in their stock prices. That means that it's extremely vulnerable to a 10, 20, 30% decline later this year. So there are any number of factors that could come together and make this very fine mulligatawny soup that takes gold back up over $5,000.
The demand side, reduced demand both on the retail and industrial side for silver. Is there anything significant that you'd pull out on the supply side for silver? Anything from the miners? Have they responded to higher prices or not so much? I also know a lot of silver is a byproduct of base metals mines and that kind of thing. So anything you'd pull out there?
Well, again, as I said, there's a lot of scrap coming in, and a lot of it's been investor material as opposed to traditional scrap. But you are seeing traditional scrap come in.
Markets climbed, but concentration risk kept getting worse beneath the surface. According to Jeffrey Christian, investor confidence may be relying on fewer narratives and narrower leadership than most people realize. That matters because periods of elevated valuations and geopolitical stress historically create asymmetric reactions when sentiment shifts. For long-term wealth protection, diversification is not enough if every asset depends on the same confidence cycle. Next, Jeffrey Christian exposes the hidden relationship between market concentration and precious metals demand.
Mining side, you'll see a much slower response. But yes, the mining industry is responding to the higher prices. They have enormous reserves and resources that they can develop, but that's going to take a long period of time. You are seeing a couple companies, go public and raise money, and that's going on. In terms of the byproduct producers, you have seen an increase in hedging of byproduct silver. They still won't hedge their primary products because they want their investors to think that they're fully exposed to the upside, even at the risk of being fully exposed to the downside. But they will hedge their byproduct silver. And we have seen an increase in hedging. But, the mining sector is going to take several years to respond to higher prices, in contrast to the scrap business, which is almost immediate.
Yeah. I think we have to always remember how long it can take. So in terms of the price, it sounds like similar to gold, trading sideways with volatility over the course of the summer. I think you said between that 60 to 90 range. And then potentially is silver going to move higher again with gold toward the end of the year? I think a lot of people are wondering, can it take another run at that $100 triple digit level?
I think it can take another run at that, and we're working right now. We're going through this whole issue. It's a very interesting time for silver and for gold, because you've got the fundamentals of mine production, secondary supply, and fabrication demand sort of suggesting that prices are too high to be long-term sustainable.
Higher prices do not instantly create higher supply, and that lag changes everything. What Jeffrey Christian is highlighting is that mining responds in years while sentiment and scrap respond in weeks. That disconnect creates periods where markets appear overvalued yet remain supported longer than expected. Investors waiting for supply relief before positioning often discover the repricing already happened. Next, Jeffrey Christian reveals the contradiction between long-term sustainability and short-term scarcity.
That doesn't mean that they can't stay this high for 3 or 5 years, but in the long run, beyond 5 years, they're probably unsustainable. But the other fundamental is investment demand. And it says, prices can stay this high as long as the economic and political risks and uncertainties are there. We're not going to let up on our interest in having more of our wealth in gold and silver until the world looks like a safer place. So you tell us when the world's going to be a safer place, and we'll tell you when the prices of gold and silver could fall. So I do think that the price of silver will make another run to $90 and $100. And I think that it could stay high for a period of a year or two more, and maybe even longer, depending on how the rest of the world develops or doesn't.
If risk becomes permanent, expensive assets can stay expensive far longer than models predict. This is where Jeffrey Christian's thesis shifts from supply fundamentals toward the psychology of capital preservation. Investment demand does not need perfect economics. It needs persistent uncertainty and declining trust in traditional shelters. For savers, the real threat may not be paying too much, but waiting for conditions that never normalize.